Here's something literally nobody tells you when you're just starting out on your financial journey. The person who invests $1,000 today and then does almost absolutely nothing after that is almost certainly going to end up wealthier than the person sweating over their computer, aggressively picking stocks every single week for the next decade. I know, right? It feels completely backwards. It feels like the person hustling and doing more should win, because that's how literally everything else in life works. But as we'll see in this explainer, money is highly, highly counterintuitive. Okay, let's dive into this and look at the real story of your first $1,000, what it can actually do, and what almost everyone gets wrong before they even start. To really wrap your head around wealth, you gotta understand that money works a lot like a giant machine. The problem? Most people spend their entire lives just pushing that machine from the outside. They're sweating, they're exhausted, frantically trading individual stocks or trying to perfectly time the market, totally convinced they're making progress. But the effortless reality, the real secret, is that all they actually had to do was get inside the machine and just let it run for them. Wealth isn't about constant action, it's about harnessing the mechanics of time and compounding. Which brings us to section 1. The cost of waiting. Let's be totally honest here, $1,000 isn't exactly a massive, life-changing amount of money all on its own. I mean, if you live in a big city, that's maybe a couple months of groceries, a quick flight, or just fixing a minor dent in your car. But we need to look at the incredibly uncomfortable math of what happens if you just sit on that money instead of putting it to work. Take a look at this number right here, $45,000. If you're 25 years old and you invest just a single $1,000 today, and you never, and I mean absolutely never, add another single dollar to it, the historical average market return of roughly 10% a year means that by the time you hit 65, that initial $1,000 has blossomed into about $45,000. Think about that. You didn't answer a single email for that money. You didn't wake up early for it. It just happened because that compounding machine was quietly running in the background while you were out living your life. Now, here's the part that should genuinely make you a little upset. This is the invisible cost of waiting. Most of us tell ourselves, well, I'll wait until I have a bit more money, or I'll jump in when the market feels safer. But look what happens if you delay just 10 years before investing that exact same $1,000. That end result of $45,000, it shrinks dramatically, down to just $17,000. By doing absolutely nothing for a decade, you effectively just lost $28,000. Delaying is literally destroying your future wealth. So the crucial point is, Section 2, before you invest anything. Before you get all swept up in the excitement of investing, there are some absolutely vital prerequisites. You literally cannot afford to skip these steps before you even think about touching a brokerage account. Step 1 is incredibly boring, but it's genuinely the most important financial decision you can ever make. Clear out your high-interest debt first. And step 2? Build an emergency fund of 3 to 6 months of basic living expenses and keep it entirely out of the stock market in a reliable high-yield savings account. Why? Well, because the single biggest mistake new investors make isn't picking the wrong stock. It's being forced to sell the right investments at the absolute worst time just because, life happened and the car broke down. To really get why holding debt while investing is such a terrible idea, just look at the math here. The stock market historically returns an average of 10% a year, right? But remember, that fluctuates. Your credit card interest, however, sitting at 18 to 25%, yeah, that is practically guaranteed. If you're trying to earn a 10% market gain while simultaneously paying 25% on a credit card balance, it is just mathematically irrational. You're basically treading water and trying to convince yourself you're swimming. Clear the debt first, full stop. Let's move to and see how this builds. Section 3, containers and contents. Okay, so once your debt is cleared and your emergency fund is locked in, we can finally talk about your $1,000. Let's clear up what is easily the biggest point of confusion for beginners when it comes to the actual mechanics of investing. See, there are two separate questions that often sounds like one. What account do you use and what do you put inside it? It helps to think of the account as the container and the investment as the contents inside that container. And trust me, the container you choose matters enormously to your long-term wealth. If you've got a job and a paycheck, the absolute best container in the United States is the Roth IRA. Here's how it works. You put in your normal, after-tax dollars, let's say that $1,000 we've been talking about, which is well under the $7,000 contribution limit for 2025. Then, the absolute magic happens at retirement. When you go to take that money out at age 65, you pay zero tax on the gains. None. Zilch. The government never gets to touch that massive compounded growth. It doesn't make you a smarter investor, it simply lets you keep every single penny the market gives you.
Now, what do you actually put inside that Roth IRA container? Most people kind of think investing means gambling on individual companies. But just look at this staggering data. Over a 15-year period, 80 to 90% of actively managed funds, these are funds run by literal professionals with elite degrees in high-end software, they actually failed to beat the basic market average. Let that sink in. Meanwhile, a simple total market index fund, which requires zero effort from you, beats the vast majority of the pros. You really shouldn't try to be clever here. Just buy the whole market.
And this is what an index fund actually looks like in practice. It's basically a single basket holding tiny little pieces of hundreds or even thousands of stocks all at once. When you buy one single share, you're buying a microscopic slice of Apple, Microsoft, Johnson & Johnson, and the broader economy, all simultaneously. You aren't placing a risky bet on one company to win, you're making the incredibly safe bet that human economic activity will just continue to grow over time. Actually, this is the exact strategy Warren Buffett publicly championed. He even famously won a $1 million bet proving its superiority over hedge funds. Moving on to Section 4, the silent wealth tax. All right, so we've got our container, we have our index fund, but we seriously need to discuss the insidious villain of this entire financial playbook, management fees. Check out this number. 30 cents. That is how much you typically pay in fees for a whole year on a $1,000 investment in a standard total market index fund, thanks to expense ratios sitting right around 0.03%. I mean, it's virtually nothing. And keeping your costs to virtually nothing is the real secret to keeping your wealth. And this brilliantly illustrates exactly why those fees matter so much. Let's look at a $10,000 investment over 30 years, both earning that same 10% return. Fund A charges that tiny 0.03% fee. Fund B, which is exactly the kind of thing often recommended by big banks, charges what sounds like a completely harmless 1% fee. Over 30 years, Fund A grows to $170,000, but Fund B, only $130,000. That tiny, seemingly harmless 1% fee secretly drained $40,000 from your wealth. Not for better performance, mind you, just for existing. Crazy, right? Finally, Section 5. The art of nothing. So everything we've discussed so far, the Roth IRA, the index funds, the low fees, it's all legitimate, deeply evidence-backed strategy. But knowing the mechanics is entirely different from surviving the psychology, because the single most difficult part of investing is the painful wait and the intense temptation to panic. I mean, do you remember 2020? The market dropped 34% in just 33 days. It was literally the fastest crash in history. People were absolutely terrified, and they panic sold their investments. But guess what? The market recovered to all-time highs within months. Those who panicked permanently locked in their losses. But the people who gritted their teeth and did absolutely nothing, they came out way ahead. Now, what's really interesting about this slide is this legendary internal study from Fidelity. When they analyzed which retail investors performed the absolute best over time, the data pointed to a genuinely shocking conclusion. The best returns? They belonged to people who had completely forgotten they even had an account. Or, well, people who were dead. I know, it sounds like a dark joke, but it perfectly proves that absolute stillness, just resisting the urge to tinker or panic, equals maximum reward. If you're sitting there wondering why financial literacy feels so confusing or why this wasn't taught to you in school, just look at this timeline. For most of history, compounding wealth was completely locked away for the elite. I mean, index funds didn't even exist until 1976. The Roth IRA, that wasn't a thing until 1997. And the ability to literally buy these assets on your phone for zero commission is barely a decade old. These specific wealth-building tools are genuinely brand new for ordinary people. So take a breath. It is entirely okay if you're just learning about this stuff right now. Ultimately, the mechanics are simple. You open an account, you buy a low-cost index fund, and you let the machine run. But the real test here is a uniquely human one. We are so hardwired for motion, for agency, and to react aggressively to the news cycle. But the market heavily rewards stillness. So the ultimate question isn't actually what stock to pick. It's this. Can you hold your ground in a world aggressively wired to sell you motion? Can you just leave your money alone long enough to let it become something incredible? Start your playbook, embrace the stillness, and let time do the heavy lifting.